In the late 1970s and early 1980s, Japan was not just rising, it was terrifying the world. Factories ran day and night, ports glowed with container ships, bullet trains sliced through cities like steel veins, carrying the lifeblood of a new economic superpower. Japanese cars flooded American highways. Japanese electronics sat in living rooms across Europe. And in boardrooms from New York to London, one question echoed quietly, uneasily: was Japan about to replace the United States as the world's dominant economic power? To the public, the answer seemed obvious. Japan had achieved what no defeated nation in history ever had. Reduced to ashes in 1945, it had rebuilt itself into the second-largest economy on Earth within a single generation. Newspapers called it the Japanese miracle. Economists studied it. Politicians feared it. But behind the neon lights of Tokyo and the polite smiles of salarymen, something dangerous was forming, something fragile, something no one wanted to acknowledge. By the mid-1980s, Japan was drowning in success. Its export machine was so powerful that it destabilized global trade. The United States ran massive deficits. Europe complained of unfair competition. Pressure mounted on Japan to slow down, to rebalance, to stop overwhelming the world, and Japan agreed. But instead of slowing safely, it chose a path that would quietly poison its own economy. In 1985, finance ministers from the world's largest economies gathered at the Plaza Hotel in New York. The agreement they signed, that the Plaza Accord, was meant to correct global imbalances. The Japanese yen would rise, the dollar would fall, trade tensions would ease. On paper, it was a technical adjustment. In reality, it was the first domino. As the yen surged in value, Japanese exports became more expensive overnight. Corporate profits came under pressure. The government panicked, not publicly, but internally. Japan's leaders had built legitimacy on growth. Slowing down meant risking unemployment, social unrest, and the collapse of confidence. So they chose stimulation. Cheap money flooded the system. Interest rates were slashed. Banks were encouraged quietly, relentlessly to lend, not cautiously, not selectively, but aggressively. Money poured into real estate, into stocks, into speculation. Land prices in Tokyo began to defy gravity. Soon, the ground beneath the imperial palace was said to be worth more than all the real estate in California combined. It sounded absurd, but everyone believed it, because in Japan, assets didn't fall, they only rose, or so they thought. This was the moment the miracle stopped being real-land, became an illusion. And once illusions take hold at a national scale, the collapse is never contained. It spreads. By the late 1980s, Japan was no longer behaving like a normal economy. It was behaving like a belief system. In Tokyo, land stopped being valued for what it produced and started being valued for what it symbolized. A small office building in Ginza could be worth more than an entire manufacturing town in Europe. Families spoke of land not as property, but as destiny. Corporations no longer measured success by profits, but by how much real estate sat on their balance sheets. Banks fed the frenzy. Japanese banks were not reckless in the Western sense. They were obedient. The government wanted growth. The central bank wanted stability. And stability, everyone agreed, meant keeping asset prices rising. So loans were issued not based on income or productivity, but on collateral land, whose price was assumed to never fall. Companies borrowed against land to buy stocks. They used stocks as collateral to buy more land. They borrowed again to speculate further. It was a closed loop of artificial wealth. The Tokyo Stock Exchange reflected this madness. The Nikkei index climbed relentlessly, passing 20,000, then 30,000, then nearing 39,000 by the end of 1989. Share prices had completely disconnected from corporate earnings, but no one cared, because paper wealth was becoming real power. Japanese firms began buying the world. Rockefeller Center, Hollywood studios, golf courses in California, entire neighborhoods in Hawaii. Western newspapers panicked. Books were written predicting Japan would own America within a decade. Inside Japan, dissent was rare. To question the bubble was to question the miracle itself. And in a society built on consensus, that was almost unthinkable. Regulators looked the other way. Bankers reassured each other. Politicians enjoyed the tax revenue. Ordinary citizens watched their net worth explode without lifting a finger. This was not greed in the traditional sense. It was collective hypnosis. Then, quietly, the pressure began to build. Inflation fears emerged. The central bank grew nervous. Asset prices were soaring too fast. Wages could not keep up. Inequality widened. And in a moment that would later be remembered as catastrophic, the Bank of Japan decided to act. Interest rates were raised, at first gently, then repeatedly. The assumption was simple: cool the market without breaking it, a soft landing, a controlled deflation of excess. But bubbles are not balloons, they are pressure vessels. And when pressure shifts too quickly, they don't deflate, they rupture. In early 1990, the stock market began to wobble, then fall, then collapse. The Nikkei plunged, investors panicked. Margin calls spread, confidence evaporated. Land prices followed. For the first time in modern Japanese history, property values declined, collateral vanished. Loans turned toxic overnight, and the banking system, once the pride of Asia, found itself standing on sand. Japan had built an economy on the belief that wealth could multiply without limit. Now it was about to learn what happens when belief collides with arithmetic, and this time the consequences would not stop at Japan's borders. When the bubble burst, Japan expected pain. What it did not expect was paralysis. At first, the damage looked manageable. Stock prices fell, but Japan had weathered downturns before. Property values declined, but land was still land. The government reassured the public. Bank executives promised stability. The phrase most often repeated in Tokyo was calm, deliberate, and dangerously misleading, a temporary correction. But this collapse was not a storm. It was a climate shift. As asset prices kept falling, banks discovered the truth they had avoided for years. Their balance sheets were rotten. Loans that had once been considered the safest in the world were now backed by collateral, worth far less than the debt itself. Entire portfolios were technically insolvent. Yet the banks did not fail. They were not allowed to. Japan's leaders made a fateful decision. Do not let anything collapse openly. No dramatic bankruptcies, no mass layoffs, no visible panic. Stability, even if artificial, would be preserved at all costs. And so Japan invented a new financial creature, the zombie bank. Institutions that were functionally dead but kept alive through quiet support, regulatory forgiveness, and accounting illusions. Bad loans were rolled over instead of written off. Losses were hidden. Insolvency was postponed indefinitely. The result was an economy that could no longer move. Banks stopped lending not because interest rates were high, but because trust was gone. Companies stopped investing not because demand vanished, but because the future had become unknowable. Consumers stopped spending not because they were poor, but because they were afraid. Prices began to fall. Deflation set in. And deflation is not merely falling prices, it is frozen time. Every yen becomes more valuable tomorrow than today. Every purchase feels like a mistake. Every investment looks premature. The rational decision becomes inaction. Japan entered what would later be called the lost decade. Then another and another. Growth stagnated. Innovation slowed. A generation of young people graduated into an economy with no momentum, no confidence, and no clear path forward. Lifetime employment, the sacred pillar of post-war Japan, began to crack. Yet still, the system refused to reset. Unlike Western crises that burned fast and violently, Japan's collapse smoldered. No dramatic revolutions, no sudden recoveries, just a slow, grinding erosion of potential. And while Japan remained trapped in its own ruins, the shockwaves began to spread outward. Japanese banks had not only lent at home, they had flooded Asia with capital throughout the 1980s. Cheap Japanese money had fueled property booms in Thailand, South Korea, Indonesia, and beyond. Now that money was being pulled back, quietly at first, then urgently. Asia had enjoyed the fire. It was about to feel the ashes. In the 1980s, Japan was not just an economy. It was Asia's financial engine. Japanese banks, flush with easy money during the bubble years, had poured capital across the region. They funded skyscrapers in Bangkok, factories in South Korea, infrastructure in Indonesia, and real estate booms from Manila to Kuala Lumpur. For many Asian economies, Japanese capital was not supplemental, it was foundational. And like all foundations built on borrowed confidence, it was fragile. When Japan's bubble burst, its banks did not simply retreat inward. They were forced to, As losses mounted at home, regulators pressured them to shore up domestic balance sheets. The fastest way to do that was not innovation or reform. It was withdrawal. Loans were called in, credit lines were frozen. New financing vanished. Projects that had assumed endless liquidity suddenly found themselves gasping for air. Across Asia, the symptoms appeared eerily familiar. Property prices stalled, stock markets wobbled, currencies came under pressure. What had once been celebrated as the Asian growth miracle began to look suspiciously like a series of interconnected bubbles, all inflated by the same source: cheap Japanese money. The effects were not immediate. For several years, Asian economies tried to compensate. Governments borrowed more. Domestic banks stepped in. Growth numbers were maintained on paper. But the structural weakness had already been exposed. Many Asian countries had pegged their currencies or managed them tightly against the US dollar. This worked as long as capital flowed in. When it flowed out, defending those pegs became a losing battle. Japan's stagnation had removed a critical stabilizer. Then came the tipping point. In 1997, Thailand's property market collapsed. The government ran out of reserves trying to defend the baht. When the peg finally broke, panic spread like fire through dry grass. Investors reassessed everything: South Korea, Indonesia, Malaysia, the Philippines. One by one, currencies fell. Stock markets crashed. Companies collapsed under foreign-denominated debt they could no longer repay. What began as a regional correction became the Asian financial crisis, and behind it, silently but unmistakably, stood Japan's long shadow. Japan did not cause the crisis alone. Structural weaknesses existed everywhere, but Japan's collapse removed the largest source of patient capital Asia had ever known. When that support vanished, the entire system was exposed. The cruel irony was this: Japan had not destroyed Asia through aggression or dominance. It had done so through failure. A failure to confront its own collapse decisively. A failure to clean its banking system. A failure to let the bubble die quickly. The consequences rippled outward, punishing countries that had believed Japan's miracle was permanent. And as Asia burned, the world took note, because Japan's story was no longer just a regional tragedy. It was a warning. Japan's bubble did not end with a single crash, a single reform, or a single moment of reckoning. It ended with exhaustion. By the early 2000s, the world had moved on. New booms had emerged in Silicon Valley, in China, in global housing markets. Japan remained wealthy, orderly, and functional, but no longer dynamic. It had become a case study quietly referenced by economists and quietly ignored by policymakers, until the same patterns began to reappear elsewhere. Japan's experience revealed several lessons: clear, brutal, and deeply uncomfortable. The first was this: asset prices are not prosperity. For years, Japan mistook rising land and stock values for real economic strength. Productivity stagnated while balance sheets expanded. Innovation slowed while speculation accelerated. When the assets collapsed, there was nothing underneath to catch the fall. The second lesson was more dangerous. Delay is not stability. By refusing to allow banks and corporations to fail openly, Japan traded short-term.com for long-term stagnation. Zombie institutions absorbed capital that should have gone to new industries. Creative destruction, the engine of renewal, was smothered in the name of social harmony. The result was an economy that survived but never healed. Third, Japan proved that deflation is far more destructive than inflation. Falling prices may sound benign, even beneficial. In reality, deflation freezes decision-making. It punishes risk. It rewards hoarding. It turns entire societies cautious, conservative, and inward-looking. Once entrenched, it is extraordinarily difficult to escape. But the most haunting lesson was this: large economies do not fail alone. Japan's bubble was domestic. Its consequences were global. Capital flows do not respect borders. When a major financial power destabilizes itself, the shockwaves travel outward, often hitting weaker economies first and hardest. The Asian financial crisis was not an accident. It was a delayed aftershock. And yet, despite all this, the world did not truly learn. In the decades that followed, governments repeated the same mistakes. Ultra-low interest rates, asset inflation disconnected from wages. Faith in central banks to manage everything smoothly. Confidence that modern systems were too sophisticated to collapse. Japan had shown that sophistication does not prevent bubbles. It only hides them longer. Today, Japan's bubble economy stands as one of the most important economic tragedies of the modern era. Not because it ended an empire, but because it demonstrated how easily success can turn into self-destruction. When discipline is replaced by denial, the miracle went too far, and when it broke, it almost took a continent with it.